Bear with me 1 second here.
Sure.
All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. Today we are joined by Eddie Austin. Eddie is a serial entrepreneur and CEO of JE Capital. He is passionate about building companies and with better values, and offers a great return to his investors. After 8 years of hard work, he launched his first real estate investment fund using an innovative capital structure to drive profitability and growth. Eddie, we're excited to have you here with us today. If you could tell the listeners a little bit more about yourself.
Sure. Thank you for the intro. So, I've always found myself as being a very passionate person to help other people. I've done numerous roles throughout the years, growing up with, some great traits, but, coming from industrial America, just being a hammer and being out there in the world where you work with a lot of older people. And, being one of those people that was directly impacted by the 2008 through 10, I always ask the question, did it have to be that way for everyone? And I knew there was people out there that didn't get impacted like that. So through that path, it really got me to think differently. And, my background is I grew up in South Florida. I grew up a little bit in Tennessee and also Indiana, currently in Indiana right now. And with that, I got to see a lot of different terrain and a lot of different types of people and work in a lot of different industries. So my background was very diverse, and I knew that I wanted to do something different than just be a W-2 employee. So I always knew inside I wanted to be an entrepreneur, run around telling everybody I wanted to retire by 40. Didn't know what that looked like. But at 36, I walked away from my last W-2 job, and I've been doing this ever since, at the same time running my own companies. So to really dive in, I worked alongside these people being managers and understanding that they had these dreams of retirement. They had these dreams to go on these vacations and on these fishing trips and hunting trips, and they're going to use their W-2 to do that and their 401ks. And unfortunately, I got to a place I could realize that that's probably not going to happen. So I become very passionate about trying to build a company that could take 401ks, IRAs, and give the everyday person an opportunity to truly retire and to have the money to be able to do that and not have the fear of outliving their retirement. So that's kind of what gave me my why to pursue the path that I did to open my first real estate investment company in 2019 and launching my first fund in 2020.
That's huge. That goes into my first question, because with behind every successful entrepreneur, there's always the mentors and people that kind of shape you with where you go. How did your mentors and your business experiences shape your vision for JE Capital?
Man, that's a great question. So, and I like telling this story because it kind of was a discovery moment by accident. So one of my companies is a metal fabrication and hot rod shop. We had the opportunity to build a 23-foot tall stainless cello for a gentleman in another city and another state. And I knew that the gentleman we were building the sculpture for owned real estate because he was building the sculpture for the front of one of his large motels. So I really wanted to know what he did because I was extremely excited about, the things he did. It looked like he's on a very exciting path. So I run around asking everybody what 2008 through 10 was like for them, because I was in a factory at the time and we were greatly impacted. I was a supervisor. I watched a lot of my people had to leave the factory. Some of them lost their jobs, lost marriages. It was extremely difficult time. So I was very, ingrained in asking the question, what did 2008 through 10 like for you? So in the construction of this sculpture, we sat down for lunch one day discussing the base, the footprint of this thing, and what the foundation needed to look like. And because it's 23 foot tall and it sits next to a riverfront. So we were afraid of this thing blowing over on the public and stuff. And, so we were discussing that. He had some ideas from the structural engineer that he just wanted to know my mechanical background, what I thought was. So during this lunch meeting, One of the things he asked me was, Eddie, you're an entrepreneur. You're still working a W-2 at the same time. What is Eddie Austin capable of if he didn't have a W-2 job? I can tell you that was the longest 45-minute ride home because, although we joke around and ask ourselves, what could we do if we didn't have a job?
Yeah.
When someone else asks you the question, it hits different. And then I asked him, what was 2008 through 10 like? And he said, well, Eddie, honestly, it was the best years we ever had. And, my head hit the table. I was like, really? Well, can you tell me what that looked like? So at that point, he became my mentor. And he didn't give me the secret sauce, but what he told me is, Eddie, success leaves clues, follow the money, read financial books, and just study the wealthy. You'll figure it out. And that's the best way you're going to learn this stuff. So that goes in that 8 years inside my bio. Those 7, 8 years, that's all I did. I was in the mix of building a solar company and putting about 60,000 miles on my vehicle every year, running up and down the highway. So I had audiobook after audiobook, reading, everything come down the super wealthy and the people that have indestructible wealth, I like to call it, they have real estate.
Yeah.
Large real estate, commercial, industrial, multifamily. So how does a person like me and you get to that space? Like we could work our whole life and never afford a $10 million down payment on a large multifamily property. And that's the property that will change our lives, me and you both. So it comes down to OPM. How do you legally do that? Then it come into, okay, fund management. I didn't start as a syndicator. I did a few tenant and commons, but I went straight from syndication or from tenant and common straight to funds.
What is the tenant in common structure compared to syndication?
So a tenant in common is a very kind of a secretive style thing. It's basically a bunch of friends that decide that they want to go to a bank and go to, form a legal entity without limited partnerships. So you're all partners inside of this. And say you're a high net worth guy. I'm a guy with a lot of management experience of properties. And then someone else has a piece of property they brought to us. So we form a tenant in common. We're all people in common with a common goal to operate this property. We build this legal structure called a TIC, and we take that to the bank and say, hey, Josh is bringing the money to close this, plus the financial statement to be able to sign on the loan. He's a loan guarantor. I'm the property manager. I'm going to manage the asset. And then, of course, the other guy, he needs to have some, not skin in the game, but he needs to put in some time too into this asset. He just can't bring it to us and then just say, I'm going to sit in the LLC. He has to actually operate, maybe the finances, do some reporting on the property. Everybody has to work into this deal.
Everybody's got a job and a responsibility.
Yeah, everybody's got a job and a place at the table.
Got it. And I guess it's kind of like a joint venture, but or is it same sense, just different structure?
Well, it's mostly just a small legal LLC. It's just an LLC that would have 3 partners inside of it. And those partners would have an operating agreement, and that operating agreement would outline, Josh's protection by bringing the capital to the table. He's a loan guarantor. He needs to have certain oversight of the property. Eddie's responsibility are X, and we need to have monthly meetings with Josh about what's going on. Jack, which has the opportunity, it's basically a marriage.
Perfect.
Which is kind of the same way a syndication works, except it's a joint venture partnership, but it has LP and GP opportunities in it. So you have your LPs where you can legally raise money, and you would register that with Security Exchange Commission as a 506B or a 506C. Got
it. And then with that, you're going to tell us the advantages over those to a fund or a fund. I'm excited to hear about that and the differences.
So, I went straight to funds because I looked at syndication and I kind of had my own opinions on it. And I looked at a syndication this way. It's basically a fancy joint venture partnership. And it kind of derives the same way. Jack found this piece of property. Again, Josh, you've got this huge financial statement, a lot of money sitting on the sidelines. You're our loan guarantor. And then I'm the guy that, can manage this property. And we decide that, we don't want to use all of Josh's money to close this opportunity. So we want some other investors to come in along beside this as limited partnerships. So we form this opportunity. We go out here, we get a live offering, and we present it to the public if we're a 506C. And we bring in investors, tell them about our opportunity, and we close this opportunity. Well, this structure probably costs us about $20,000 to do that. And we're only going to be able to close one single property. So I kind of feel like that's a hamster wheel, because the guy that actually wants to go out here and do this full time, a full-time real estate investor, they're going to just continuously, go out and start a syndication, put these partnerships together, and then raise the money. And then essentially they've done all this work for one single property. My take is, why wouldn't you do that one time with less partners and then close multiple properties for the same amount of money?
Wow.
That's why I like the fund model. I love the fund model.
And you can do a blended return, and and each property, one might be, let's not say suffering, but it might be going through the value add phase, but you've got a strong one. It's stabilizing, and the returns are balanced.
Josh, you're spot on right there. So let me take you down the road of the two different scenarios here. So syndication. We just started our own our own real estate fund coaching program to teach syndicators how to go to funds. And we do that at a very low cost of entry. And here's usually why I try to get people to do a real estate fund instead. It's the same amount of work. You're writing a narrative for a PPM. You're having a lawyer do an operating agreement. You're still having a subscription package to be able to give to your investors. It can be 506B or C. So here's the problem with syndication, in my opinion. You know how hard it is to get a pocket deal from a broker. You've probably tendered that relationship along for months, maybe even a year, taking him out to lunch, taking him out to dinner, tendering this along, proving that you're a person that can close on a property. So you identify a piece of property in a syndication. You identify this piece of property. Finally, with this broker you've worked so hard to get this opportunity with. So automatically, if you're first starting out raising capital, you're tremendously under pressure to make sure that you raise equity to close that deal, because this is your first time closing a deal with that broker. So if you don't close that deal with that broker, he may never call you again. So there's a lot of risk in that. Number two, you're raising for one opportunity, and there's risk to your investors because it's one single property. And if you were a newer person and you've bought a property that looks really good on the outside, but maybe there's a bunch of skeletons in the closet and there's a heavy value add stage, your investors don't get returns. So, and it's one single property, and you're going to have to make sure you operate that well. So there's a lot of risk to your investor. There's a risk to you and your relationship with your person that you've built this relationship for your broker. And I always ask the question, why would you guys do that to close one opportunity? There's so much exposure to that. So why wouldn't you just do the exact same thing? Advertise, you're going to still identify a piece of property. Everybody has this idea that in this fund, you're going to just blindly raise money. Well, I don't know too many people that can just go out and blindly raise money. An investor wants to know what their investment is. Do you invest in real estate? Yes. Do you invest in multifamily? Yes. Okay, what kind of properties? Oh, we usually invest in properties that are 300 to 600 units in size, but we really like properties that are 450 units at a time. Oh, really? So what areas do you like? Well, we like states, we like North Carolina, South Carolina, Florida, Texas. Okay, well, what cities? Oh, we love Dallas, like Houston, San Antonio. So those are the things that you write in your PPM. So it's not a blind raise. Everybody makes it out like you're just blindly raising money and you're going out here and just placing it all over the place. You've wrote a Bible.
Yeah.
that is your PPM, and you have to abide by that. You're fully disclosed. You know,
Yeah.
you can't raise money and go out and buy a shopping center if it's a multifamily opportunity.
Yes. Here's the buy box. And then if this property doesn't fit in the buy box, then just keep moving on until you
Exactly.
find something that's outlined. And then, and even the buying power that funds have for those brokers that have the deals, they know you've got a fund, you can execute quick, and
Oh
you've
yeah,
got
yeah.
the capital ready to deploy.
Oh,
It's
that absolutely. You know, one of the coolest things about a fund, and especially in today's market, sometimes to get a really nice property, you got to get funky. You know, so you might have to close all cash because
Yeah.
it's a very competitive offer. So with a fund, if you have money in escrow, it's totally different from a syndication. A syndication, you're raising and you're building money up in your escrow to be able to close on closing day. With a fund, you might have money, might have $30 million sitting in escrow. If it's a $15 million property, hey man, I can close this thing in 2 weeks.
Yeah.
Now you're a different phone call for your broker. Hey man, Josh has got 15 million sitting liquid. If I find him a deal, he's going to close.
Yeah. Yeah. You get the special deals, and those are the ones with the explosive returns. That's
Yeah.
it's usually how it works. And in the pocket, and a select few people know about them. And those are deals that are just done overnight.
So you touched on this already, but the second thing is diversity. You know, if you've done a fund, say you did a fund with size that you closed in your buy box, you've got 4 properties in there. And say one of them, you know, there was just certain things that wasn't uncovered until you bought it. And it's a heavy value add. So most of my funds are an 8 pref with a 70-30 on the waterfall. So that 8 pref, you know, right after we close, them investors are expecting that 8% preferred return. So if we have 3 other properties that are just cash flowing like crazy, we can still maintain that 8% preferred return, no trouble at all. But if you're one single property, it's going to ding you, you know,
Yeah.
and that's when investors start getting worried. And you have to communicate as that manager to those people, hey, this is what's going on. And, you know, we found a couple of things we didn't think about. The units are taking longer to turn them. So that becomes a real conversational stage that hopefully you have that trust with your investors that they understand. Some of them may not.
And with your structure, do you start out at 70-30, and then do you all have hurdles for the, say, the internal rate of return to reach a certain metric, and then that split? The idea, the hope is for that split to kind of equalize, because that's an alignment of interest. We've met performance hurdles, and everyone wins and keeps winning as the property does better. Is that how you're set up?
So no, we're more of a straight out 8 pref with a 70-30, and the IRR is just whatever that hurdle is. So that internal rate of return is just, it's whatever metric it hits. You know, we advertise anywhere from a 15 to 24% IRR return, internal rate of return. So we've done syndications with that exact method that you're talking about, where we have certain hurdles that we have to hit. But it's most likely a property we identified that we're going to have some heavy struggles up front. So we may not start the 8 pref until we got to a 12% IRR on the property or something like that. Or maybe we knew we were going to start at a 6% rate of return. And then after we cleared certain hurdles, we would either drop the waterfall or raise the pref.
Got it. Very cool. Yeah, and it just kind of keeps everything equalized too. But on a fund, now that I'm thinking of it, it would be extremely hard, because you're not dealing with an asset singularly. You're dealing with more vertical. It's
Exactly.
the assets are all blended rate of return.
Right. So inside our fund, you know, this is how we usually say this, and we're very active buyers. So what we do is we have a 1-year harvest period. You have 1 year to raise money, different than a syndication. So you can be open for 1 year. And then we have a harvest period that is that 1 year. And then we have a 3 to 5 year lockup, or however long our terms is and how long we hold our properties. So a lot of people say, well, I don't want to have my money locked up for a year with no returns. Well, being that we're very active sponsors and buyers, you know, we're deploying capital pretty quickly. And on our next fund, we're going to do more of a fund to fund model to where we can provide pref equity and opportunities to people that need equity right away. So those properties would cash flow almost, within the first day of closing,
Got it. Wow.
Is it normally you're about 60 to 90 days or 45 days of the first cash output to your investor?
Got it. Do say the cash is sitting there, does that just accumulate the 8 prep until it's able to be paid, or does it do you wait until it's deployed?
It has to be deployed. Another
Okay.
thing we do with our funds, so if it's a $10 million fund and we know that we probably need $5 million to actually do something with, we do an activation slot. So that being $5 million. So if we raise $4.5 million and we just did not cross that $5 million threshold, then we would essentially have to give the money back if we never got there, because the fund never become active.
Got it.
And then
Yeah.
once we identify a property, we communicate back through our CRM with our investors. We've identified X property. This is what the return metrics look like. Capital will be deployed on essentially X date, and then you can expect returns after that.
Got it. Very cool. What are some challenges you face in the real estate industry, and how have you overcome them?
So we've faced many challenges, but having the right people on your team that can help you with underwriting, help you with debt, sourcing debt. We're all out here looking for money and deals. That's our number one. I'm sure you're a real estate professional yourself. So you're always ear to the ground for capital, and you're always ear to the ground for deals. So those are your two things. That's one thing I think with a fund, it makes things a little easier because we raise a lot of institutional money. And so, sometimes, and this is one of my biggest shortfalls. So we had a $20 million fund. We had a phone call with a Utah office. They kind of dug into us a little bit, did some due diligence. They got on a phone call. After about 30 minutes, they loved everything about our company, was ready to invest, and they were going to wire us $50 million. We could only facilitate 20 million. At that point, I realized I thought too small.
Oh,
and
wow.
They wouldn't do less than 50. And I said, well, what is your max? And they said, we usually 250 to $300 million. And so my capital raising would have been done. I would have done one single wire. We'd have had $50 million to deploy. And it was a hedge fund style family office.
Yeah.
So they were just looking to deploy capital into a real estate arm.
Nice. It's
That was too small.
But man, it's and then you get to go shopping and find great deals, and you've got the buying power.
Right.
That's incredible. Because it's like be able to rapidly purchase properties and not have to go through all of the process for the bank and inspections, and of course your due diligence is there, but the bank, then the third party inspections, it can cut off and shave a ton of time.
Oh, it can so much. And again, a lot of your deal shops, some of these really big deals come from super big brokerage firms, and they immediately want to see proof of funds, letter of intents right away that are super saucy. So it gives you that ability.
Yeah. Yeah. And a good thing, a lot of things have changed with real estate. And I think the going hard day one with your earnest money, I think for the most part, those days are behind us.
God, and I hope so, man.
And what that means is that you put a deposit down that locks you in at your earnest money, and then it's non-refundable no matter what happens, whether you close or not. And that's for the audience. I know very well, but it's that just when that started happening, so that the sponsorship teams can be more competitive. It's just, and then you're sub 4 cap, sub 5 cap on a purchase price, and we're seeing some things shake up on that front too.
Oh man, to go along with that, we walked away from some great opportunities in South Texas that they were just hardcore, that there would be no due diligence. It's money, hard money, earnest money down day one. And I said, look, and they were telling me, look, this is the new national standard. This is the way things will be done. And I said, look, I'm a non-transactional person. I am a relationship person.
Yeah.
I will fly down there. I will look at the property, but I will not say hard money on day one. We're going to do some due diligence. If the foundation's cracked, we're not giving you hard money day one. I'm telling you this. And I'm glad to see us finally get away from those style things, because there's a lot of opportunities that never went anywhere. I know people that lost a lot of money. I know one guy in particular, he lost $1 million.
On just money going hard and not
Yeah.
getting refunded. Yeah.
On
Yeah.
one single deal. It was $1 million hard day one. They got in the property. They found some EPA stuff on the thing. And I think he's still in a lawsuit to try and get his money back out.
Some lead paint and then, yeah, the lender wouldn't close unless that's been remediated. And
Mhm.
yeah, that could be, and I think that the losses are still going to mount if a lot of these buying based on pro forma, future values.
Oh God.
Rented
So-
for the
Yeah. So COVID and that fake pump of appreciation that we just went through and compressed cap rates, and these brokers sending us this pro forma of what rents are, as well as I do, man. We've always underwrote properties at 2.5%, 3% rent growth, and they're hitting strides of 15, 25%. And that's what their pro formas are wrote on. And you're like, although you may ask that, how can you retain your tenant base with that? Because eventually the money runs out.
Oh yeah. Yeah. And you have to buy the property at the pro forma NOI, not the in place. It's
Oh yeah. They were hardcore in their price at like, this is the price based off the NOI. That's not the actual NOI. That's what you believe the NOI is. And here's the thing. I know people that bought those properties.
Yeah.
And when they bought them, they couldn't maintain tenants because they found out they couldn't pay that. The market couldn't handle that cost of rent for a 1-bedroom, 2-bedroom. And now they're sitting on properties that they bought for this fake pump of an NOI for that sale price. And now they're back down to a reasonable NOI, and they paid too much.
Yeah.
And they can't cash flow.
They're finding out how the amount of work it takes to do the increases and the tenant and turning the tenants to get to the pro forma. It's a lot of work. It takes time.
Well,
And,
I would rather have a property with good tenant retention,
mhm.
meaning we're doing a good job at, having amenities that people like. We're having a product that people like to live at. It's a good spot in the community. And that I know that tenant's going to be there a long time. They're going to just continue renewing that lease.
Yeah.
And they're expected, and they know it's coming that, hey, the rent goes up 2.5%, 3%, on annually. So they know that's going to be okay. But when you have tenants in there that you're just flipping people in and out all the time, just the traffic on your property, the move in and out, they scuff your walls, they tear up your floor, the door gets broke, it's no fun. It's just time from the sponsor.
No, it's definitely a process, and it's some can do it well, and some it's a learning lesson for them.
Mm-hmm.
All right, can you share with us particularly exciting or memorable moments in your journey as an entrepreneur?
Yes. So honestly, most exciting is actually, I would say, every day. One of the cool things about going back to that sculpture moment. So when we unveiled that sculpture to the city, I had an opportunity to speak. It left me with something, because that day, seeing the excitement on people's faces was really gave you chills. Super exciting, and that gave me a place to think about, how do I do this more often? So when I go to these real estate meetups and when I go to these conferences, and you have these conversations about the different innovative ways that you're doing real estate funds, or you're buying properties, or you're giving your knowledge away to a younger sponsor or someone that would like to get in the space that's brand new, when you give them that education and they get excited about it, and you instantly see that hope inside of them that this is possible, that I can leave my Walmart job and get the education, or keep my Walmart job until I can find a duplex, a fourplex, or ultimately partner with someone on a large property. that excitement is what excites me. That's the gratification, is helping other people.
Awesome. And you can see a transition.
It is.
Before
It's so cool. And they call you up, they remember you, that they met you at the Best Ever conference, and you told them a few little secrets and seeds on how to get started. And they probably had a phone call or two. And then they call you up and they say, I closed my first property. Nothing feels better than that. So I guess I kind of like to live through other people's wins. I have my own wins, but I have a hard time not counting my small wins. I have to back up sometimes and realize that, getting up before the sun, working on the business, keeping people happy, maintaining employees are wins. Although I feel like a win for Eddie Austin is launching a $100 million private equity fund and fully subscribing that in 2 months. That's
massive.
Huge goals, but those are also ones that come with great adversity and a lot of depression when they don't work as fast as you think. So I would tell everybody, you got to count your wins, even the smallest ones.
Yeah, entrepreneurs, they definitely beat ourselves up a lot, and definitely don't celebrate the successes along the way like we should be. Totally
and also, celebrate when you give passion to other people.
Yeah.
When you've helped somebody else, that's huge to them. That's a win too, to be able to give someone else the idea they can be an entrepreneur too.
It just takes one dot to connect to another one, and you change someone's trajectory on where they're heading. What advice would you give someone just starting out in real estate?
I know this has probably been said a lot of the times in space. Read Rich Dad Poor Dad.
Yeah.
Start right there, because if you grew up listening to mom and dad and grandpa and your brother and sister and your boss, they all told you, don't deal with the tenant termites and toilets, don't deal with rental property, don't invest in rental property, don't become an entrepreneur. So wrong. Don't listen to that stuff. There's people that do this every day. I got a podcast coming up about rental arbitrage with another gentleman out of South Florida. And you could start that business with a credit card, and I know that's high level stuff. Maybe we should back up and do one of these.
Is that Airbnbs?
Yeah. So basically, finding a sponsor like myself that has a piece of property, I'm renting a bedroom out for, $1,100 for a month. Somebody comes in and gives me a month to month or on a credit card for $1,100. And then they turn around and they rent that thing out on Airbnb or a VRBO. And they're making $4,500 a month off my one room. But they're the one managing all that stuff.
Yeah.
It's just incredible the different ways you can make money. So I guess first I would give someone, read Rich Dad Poor Dad, and then don't stop there. Keep reading, get on YouTube. Man, YouTube today is, this is probably going to go on YouTube.
Yeah. Yeah, it's the knowledge, the content is 100% out there, and I know starting out it's extremely tough to connect dots and find what means what, like DSCR, debt service coverage ratio. All right, what does that mean, and how is that correlated with the property? But those are dots that you connect over time. It's just it takes time getting in the right rooms, connecting to the right people, and maybe staying up later than you want, but at least you're getting the content to move it forward. But
even after you get off at work at 5 o'clock in the afternoon, there is so many meetups today in your hometowns, probably, or close within 30, 45 minutes from your hometown. Find one of these real estate meetups on Facebook and go there and just collaborate with people.
Yeah.
And I guess the big advice I'd give to somebody is, when you find a good mentor, someone that you feel like you want to model after, ask them how you can add value to them.
Yeah.
And most likely it's going to be for free. They're not going to pay you. But if they said, you know what, you could help us in the day-to-day with managing some of the operations.
Yeah.
And, you're basically an intern. But the things you'll learn working beside that person is just amazing.
You'll learn more there than you would in a lot of other places. Just being in the weeds, just learning the processes. But Eddie, I could talk to you all day, all day long.
Likewise.
If somebody wants to get a hold of you, how can they reach you?
So all of my Facebook pages and everything goes by Eddie Austin. You can go to Eddie Austin on YouTube. You can go to Eddie Austin on Facebook. And my Instagram and Twitter, the name was taken, so it's Eddie Austin BEX. That is Be Extraordinary. That's for me to, stay extraordinary in everything I do. And then on LinkedIn, it's Eddie Austin. And usually I keep the same profile picture on all profiles, so you can kind of see, okay, that's Eddie here. You'll be able to find me somewhere else.
Perfect. All right, and then I'll have your contact information when we post out the episode as well. So definitely appreciate your time. I look forward to talking to you soon, and appreciate it.
Yes, thank you so much. You have a great day.
Yes, sir. You too. Bye.